You are successful. You hold down a job. You manage a family. You run a marathon. You show up on time. You are, in every other area of your life, a highly disciplined human being. So why does that discipline evaporate the second you look at a chart? Why does the structure you impose on your entire life crumble when faced with a green or red candle? The market doesn't care about your resume. It cares about your truth. It exposes a specific, hidden weakness that only appears when genuine financial pressure is applied. This is the hidden stage of trading. You know the strategies. You have internalized the risk management rules. You can recite them perfectly in the quiet calm of Sunday morning. You have the PDF saved and highlighted. But the moment the bell rings and real capital is at risk, you become a different person. You chase the move. You widen the stop loss. You enter trades that your system explicitly forbids, justifying them with whispers of just this once. You don't lack knowledge. You suffer from a sudden, temporary, and utterly destructive lack of execution. You are stuck in the gap between knowing and doing. We often treat discipline like a fixed personality trait. Either you have it or you don't. That is a lie designed to keep you powerless. Discipline is not a trait. It is a choice. It is a commitment made in the face of maximum emotional pressure. Every time you violate your rule, it isn't a failure of character. It is a choice made to satisfy an immediate emotional urge, usually fear, greed, or the desire for immediate relief, at the expense of your long-term wealth. That is the distinction. The core lie we tell ourselves is that we lack discipline. We don't. We lack clarity on why we violate the rules we wrote. We focus entirely on the symptom, the bad trade, and never the root cause. You think the problem is that you hit the buy button too early. The real problem is the internal conversation that allowed you to hit that button. You are looking for a technique to stop the violation when you should be looking for the mechanism that triggers the desire to violate in the first place. This market is not designed to reward intelligence. It is designed to force emotional slippage. It is a pressure cooker. Think of the market as a perfectly calibrated machine whose sole purpose is to find the weakest point in your psychology and apply pressure until it bursts. Your system might be 90% perfect, but the market will find the 10% gap in your conviction the moment you are slightly tired or slightly greedy, and it will exploit it ruthlessly. It doesn't care about your indicators. It cares about your fear of missing out. It cares about your desperate need to be right. Every single trade you take is a psychological test, and if you fail that test, the market simply takes your tuition fee and moves on. We need to abandon the idea that discipline is a restrictive cage, a set of rules designed to stop you from having fun or making money. That view is childish. Discipline is, in fact, the most liberating structure you can build. It is the boundary that protects your capital and, more importantly, protects your peace of mind. True freedom in trading comes not from having infinite choices, but from having zero choices. The system dictates the action, and you simply execute. When you redefine discipline from what I can't do to the structure that guarantees my longevity, everything shifts. Most people spend 99% of their time searching for the perfect entry signal. They believe the discipline problem is solved by strategy optimization. You keep searching for the perfect strategy, but I promise you the real failure point is hiding in the 5 minutes before you even hit the trade button. It is a blind spot so subtle, so interwoven with your ego that you cannot see it until it is illuminated. We will expose that failure point in Section 3. But first, we must understand the 3 fatal errors you make every single time you sit down to trade. The first fatal error is how you define discipline itself. For most people, the word discipline carries a heavy, negative weight. They believe it is a form of suffering, a forced deprivation, or the tiresome act of sacrificing something you want immediately for something better later. They treat discipline like a cold shower, necessary for growth perhaps, but certainly something to be resisted and avoided until the last possible moment. This is the universal misconception, and it is why your efforts at self-control constantly fail. You are not choosing between pain and comfort. You are choosing between 2 inevitable types of pain. This is the discipline paradox. You see, the market does not offer a pain-free path. The choice is simply which suffering you prefer to endure. Type 1. The pain of preparation. The acute, immediate discomfort of adhering to your rules. The tedious waiting for the A-plus setup. The frustration of sitting on your hands when the market is roaring, but your edge isn't present. This is the pain of self-control. It is sharp, but it is finite, and it is manageable. Type 2. The pain of regret. This is the catastrophic, drawn-out suffering of blowing up an account, the shame of emotional meltdown, the corrosive knowledge that you failed yourself again. This pain is chronic, long-lasting, and often terminal to your trading career. The paradox is brutal and simple. The pain you avoid today guarantees the suffering you must face tomorrow. Why, then, do we consistently choose the suffering that destroys us? Instant gratification, the impulse trade, the over-leveraged position, the revenge trade. These are not fundamentally financial decisions. They are neurological responses. They offer a quick dopamine hit, resolving the immediate anxiety of waiting and giving your brain the illusion of action and control. Patience, consistency, and delayed gratification. The sustained reward of compounding profit months from now. That outcome is too abstract for the primitive part of your brain. Your limbic system screams, act now, get the feeling. It prefers the immediate, small, certain reward, the emotional relief of clicking the button, over the large, uncertain reward of true success. This is the neurological trap of the intermediate trader. This process leads directly to the concept of future self-integrity. Every time you break a rule, you are breaking a solemn contract with the person you intend to be. You are essentially stealing from your future self, creating a massive psychological debt. This debt accumulates. It manifests not just as monetary loss, but as profound self-distrust. When a perfect setup finally appears, your subconscious throws up hesitation, paralysis, and doubt. Why? Because deep down, your inner voice knows you are unreliable. It remembers the last 20 times you betrayed your own plan. It remembers the times you prioritized immediate emotional comfort over long-term financial survival. When you sit down to trade, you are meeting two versions of yourself. The disciplined version who wrote the plan in a calm, rational state, and the impulsive version who is about to execute it under pressure. The impulsive version always wins when the integrity debt is high. How can you expect to execute your analysis flawlessly when you fundamentally do not trust your own character? This lack of self-trust is the silent, invisible killer of true consistency. Let's analyze the cost of indecision. Undisciplined action is rarely about pure greed. It is usually anxiety-seeking resolution. You are uncomfortable with the uncertainty of waiting, with the feeling of inactivity. You feel you must do something to prove your worth, to justify the time spent staring at the screen. The impulse trade is merely a psychological release valve. It confirms your active status, even if it guarantees financial destruction. You trade primarily to stop feeling anxious about not trading. The market rewards those who can tolerate boredom. It punishes those who confuse activity with productivity. So, I ask you directly, which pain are you consistently choosing? And why does the chronic, corrosive pain of regret feel safer to your ego than the acute discomfort of adherence? Because failure gives your ego an excuse. It allows you to externalize the blame. The market was rigged. The signal was flawed. I had bad luck. Admitting a lack of discipline, however, forces you to look inward. It demands accountability, and accountability is terrifying to the fragile ego. You think fear is the enemy. It is not. The true enemy of discipline is comfort. We need to make the right action easier than the wrong one. We need to stop relying on brute force willpower. Willpower is finite. It is a resource that depletes throughout the day. If your trading success depends entirely on your ability to white-knuckle your way through temptation, you are guaranteed to fail. Systems, however, are infinite. To build true, lasting discipline, you must bypass the need for constant struggle. You must automate the correct behavior. That automation requires the elimination of the three fatal errors you commit every time you sit down to trade, starting with the error of relying on internal emotion over external environment. That is the leverage point we must isolate next. The leverage point is not a technical indicator. It is the moment you decide your rules don't apply to you. Let's be brutally honest about rule violation. When you move a stop loss, when you enter a trade without confirmation, you are not making an error of analysis. You are actively, consciously choosing to violate a contract you made with yourself. This isn't poor execution, it is deliberate sabotage, and the saboteur is always the same entity, the ego. The ego cannot tolerate being wrong, especially not to an impersonal, indifferent mechanism like the market. It demands validation. That tiny, insidious whisper that says, "See, if you had just held it a little longer, you would have made profit," is the voice of sabotage. That voice forces the revenge trade. It compels you to chase a runaway move just to prove that your initial directional bias was correct. You are no longer trading to make money. You are trading to prove a point. You are trading your opinion, not your system. This is the deepest form of indiscipline because you are sacrificing objective profit for temporary psychological comfort. You must internalize this truth. Every rule you break is not a mistake. It is an act of self-betrayal rooted in the desperate need to be right. Discipline does not collapse in a single grand failure. It dies by 1,000 small concessions. We call this the small slip theory. The first slip is always the most dangerous because it feels justifiable. You tell yourself, the volume is slightly different today, or I'll just size down, so this one doesn't count. That seemingly small exception is not an isolated incident. It is the establishment of a precedent. You have just taught your brain that the rules are conditional. Once the rules are conditional, they cease to be rules entirely. They become mere suggestions. And suggestions are always ignored when the pressure mounts or the opportunity seems too good to pass up. This is how the architecture of failure is built. One small, justified crack in the foundation, which then allows the flood of emotional trading to rush in. How do you spot the slip before it happens? You look for the three emotional shadows that precede every act of indiscipline. First, boredom. The market is quiet. You have been waiting for hours, and you feel the need to create action, to justify your presence in the chair. You start scanning lower time frames, looking for complexity where none exists, simply because stillness feels like failure. Second, anxiety. You just took a loss, and now you feel urgency. The desperate need to get it back fuels the revenge trade, forcing you into setups that don't meet your criteria, simply because the pain of the loss is greater than the fear of the next one. Third, and most insidious, overconfidence. You just had 3 winning trades in a row. You feel untouchable. You think you can handle a little extra risk, that the rules are for the novice, that they no longer apply to your newfound skill. Recognize this. Indiscipline is never born from clear, rational thought. It is the child of emotional extremes. If you can isolate the moment of emotional slippage, you can break the entire cycle of sabotage. The most dangerous time in your entire trading day is the 5 minutes between identifying a potential setup and actually hitting the button. This is the critical window where the ego rushes in, demanding speed, demanding urgency, whispering the fear of missing out. You must slow down time. The technique is simple, yet profound. Implement a mandatory 60-second delay. When the setup registers, you do nothing for 1 full minute. You physically stand up. You take 3 slow breaths. You read your entry checklist aloud. This mandatory pause is not fundamentally about checking the setup. It is about checking your state. You are using the external environment, the checklist, the clock, the physical act of standing, to override the internal pressure of urgency and fear. You force the rational mind back into the driver's seat before the emotional mind can execute the flawed trade. Your trading plan is not a guideline. It is a sacred text, and you must treat it as such. Within that text, you must define your no-trade zones. These are not areas where the probabilities are slightly lower. These are areas where the cost of emotional leakage is too high. If your plan says, do not trade between 11 a.m. and 1 p.m., then that time block becomes holy ground. If your plan says, do not trade on Friday afternoons, that is a boundary you cannot cross. Your discipline is not measured by how well you execute the good trades, but by how rigorously you avoid the bad trades. The greatest act of discipline, the ultimate display of self-control, is often inaction. Stop trying to be the perfect trader. The perfect trader is a myth perpetuated by the ego. True discipline is boring. It is the mastery of the mundane, the consistent repetition of tiny, correct decisions, even when they feel tedious or unnecessary. If you want true self-discipline, you must stop trying to be perfect. You must become a master of the mundane. You must build a structure so robust that failure is physically impossible. In the next section, we lay out the 1% structure that makes failure impossible. The 1% structure is not about massive, unsustainable effort. It is the quiet realization that discipline is simply compounding interest applied to your habits. The intermediate trader believes discipline is a monumental act of willpower they must summon when the market is moving against them. They wait until the volatility spikes, then try to white-knuckle their way out of a bad position. That is not discipline. That is crisis management. And crisis management always fails because willpower is a finite resource. Discipline is infinite only when it is structural. We must stop relying on the heroic, one-time effort and start relying on the tiny, correct action repeated daily. A single non-negotiable micro-habit, executed consistently, outweighs an entire week of trying hard. This is the concept of front-loading your discipline, directly addressing the greatest enemy of consistency, decision fatigue. We make our best decisions when we are rested, calm, and removed from immediate emotional pressure. This means the most critical trading decisions you make must happen before the market opens. If you wait until the session starts to decide your risk tolerance, your entry rules, or your emotional state, you have already lost. You are asking your tired, stressed brain to make complex judgments under duress. The 1% structure demands a non-negotiable pre-market routine. This routine consists of 3 actions that must be completed and checked off before the market screen even turns green. First, the review of your rules. This is not a passive reading. It is a visualization exercise. You must mentally rehearse the setup, the entry, and the exit. More importantly, you must visualize the consequence of breaking the rule. Not the P&L consequence, but the psychological consequence of self-betrayal. You are locking in the commitment. Second, defining your exact risk. Not just the dollar amount, but the maximum emotional threshold you are willing to cross today. If you hit that threshold, the session ends, regardless of time or opportunity. This is setting the stop-loss on your ego. Third, setting the emotional state. You must pause and acknowledge your current internal weather. Are you feeling revenge from yesterday? Are you overly excited by a news report? Are you anxious? If you cannot neutralize that primary emotion through breath or meditation, you do not trade. This is the first act of surrender required to win. If these 3 checkboxes are not marked, the screen remains dark, non-negotiable. This commitment transforms your trading plan from a suggestion into a procedural checklist. When the market is moving fast, you do not need to think. You need to check the box. Does the pattern match criteria A, B, and C, yes or no? The checklist removes the need for emotional judgment during the heat of the moment. It converts the chaos of possibility into the cold simplicity of procedure. The discipline required to follow a checklist is minimal compared to the discipline required to invent a reason to stay in a bad trade. We are substituting robust structure for fragile willpower. Furthermore, discipline is environmental. You must remove the digital friction that invites temptation. Close every unnecessary tab. Silence notifications. And most critically, hide the profit and loss display. The P&L display is the market's primary weapon against your psychology. It is a constantly updating score of your self-worth, and it forces emotional judgment in real time. If you remove the trigger, you remove the reactive behavior. The market is just noise until the session ends. Your job is pure execution, not scorekeeping. Your discipline doesn't fail when the market moves against you. Your discipline fails when you look in the mirror. We are now going to use the market as the ultimate psychological diagnostic tool. The true test of the 1% structure happens after the session is complete, the post-session audit. This is where you ignore the outcome and judge the process. You must open your journal and conduct an honest, objective review of rule adherence. Did you make money? That is irrelevant for the audit. The only question that matters is, did I follow the 3 non-negotiable steps pre-market, and did I follow my procedural checklist during the trade? If you made money while breaking a rule, you failed. That profit was random reinforcement of bad behavior, and it is a poison pill. If you lost money while following every single rule perfectly, you succeeded. That loss was the cost of doing business, and it reinforced the structure that will eventually lead to consistency. This objective journaling, free from the adrenaline and the bias of the session, is the deepest act of discipline. It separates the professional who judges process from the gambler who chases outcome. The journal becomes the impartial mirror reflecting your true consistency, not your luck. This objective truth is the key to unlocking the next level. Because once we have this data, we stop asking, "What did the market do?" and start asking the only question that truly matters: who am I? And when you have the answer to that, the market changes completely. We are now going to use this diagnostic tool to begin the brutal process of self-correction, targeting the specific psychological flaws revealed in your journal. The market doesn't care about your goals. It doesn't know you need to pay rent or that you just had a losing week. It is a perfect, indifferent canvas. The fundamental truth you must internalize to build genuine discipline is this: the market is neutral. It is simply a price discovery mechanism, driven by billions of independent decisions. It operates outside of your emotional framework. If you perceive chaos, if you feel turbulence, if you see cruelty in the charts, look closer. That volatility is not external. It is the raw, unedited reflection of your own internal disorder projected onto the screen. The market, in this sense, is not a test of intelligence or prediction. It is a mirror reflecting your psychological state back at you with perfect fidelity. We have been trained to ask, "What is the market doing?" The disciplined trader asks, "What am I doing?" When you chase a move, when you hit that button fueled by anger after a stop-out, that is not a market event. That is a character flaw manifesting instantly. It is an emotional trade, and it demands diagnostic analysis that has nothing to do with candlesticks. Ask yourself, when I am revenge trading, where in my life am I seeking control that I genuinely don't possess? The market becomes the proxy war for your insecurities. You are not trying to win back money. You are trying to win back the feeling of competency that the previous loss stripped away. You are demanding validation from a system that cannot give it to you. If you are paralyzed by fear, unable to pull the trigger on a perfect setup, what loss are you truly afraid of? It is rarely the money itself. The fear is deeper. The fear is of being proven wrong, of confirming the deep, quiet suspicion that you are not good enough. That fear of ultimate failure is what paralyzes the hand, and the market simply reflects that paralysis in the form of missed opportunity. Every single trade you take is a test of your character, and leverage is the psychological amplifier. We talk about financial leverage as risk management, but what about psychological leverage? The higher the leverage you use, the faster your deepest flaws are exposed. It's like putting your ego under a microscope set to 1,000 times magnification. You think you are patient until you are 30 points deep in a losing trade, and your entire system collapses into panic. That moment is the market holding up the mirror and saying, "This is who you are when pressure is applied." The undisciplined trader sees a loss and immediately tries to fix the market. The disciplined trader sees a loss and immediately tries to fix the operator. Stop pretending the market is the enemy. It is just the messenger. This leads us to the most practical application of the mirror technique. When you break a rule, and you will, your protocol must be immediate and absolute. Stop trading immediately. Do not analyze the chart. Do not look at the P and L. Close the screen and analyze the internal trigger. This is the point where the undisciplined trader tries to find another setup to make it back. The disciplined trader walks away and sits in silence. What was the true motivation for the violation? Was it boredom? Was it the need to feel important? Was it impatience? Discipline requires self-awareness, and self-awareness requires articulation. You must name the emotion precisely. You cannot just say, "I felt bad." That is useless. You must articulate, "I felt impatient because I was afraid the opportunity would pass, forcing me to wait another hour, and I equate waiting with inefficiency." That specific naming process is the foundation of discipline. If you can name the psychological trigger, you strip it of its power. You are separating the operator from the impulsive action. You are saying, "That feeling is not me. It is merely an input I can choose to ignore." This naming process also transforms how you integrate losses. A loss is data. A loss is confirmation that your edge was not present at that moment, or that your risk was too high. It is not a personal failure. Failure is when you allow the loss to violate your rules and destroy your process. The undisciplined trader internalizes the loss, equating the negative outcome with their self-worth. They say, "I am a bad trader because I lost money." The disciplined trader sees the loss as the inevitable cost of running a business, a necessary tax. They say, "The system produced a statistically normal negative outcome, and I executed the stop-loss correctly." You are not the P and L. You are the operator of the system. Your job is to execute the system flawlessly, regardless of whether the outcome is positive or negative. When you separate the operator from the outcome, the mirror stops reflecting chaos and starts reflecting clarity. It shows you exactly where your internal process needs reinforcement. Everyone talks about discipline during winning streaks. It is easy to be disciplined when the market is rewarding you for every decision. But the true test of your character, the moment the undisciplined trader quits, is during the drawdown. How do you maintain discipline when everything is telling you to panic? That is the question that decides your future in this game, and the answer lies not in strategy, but in resilience. We are now going to move into the deep mechanisms of how to build that psychological resilience. How to build the fortress of patience that survives the worst drawdowns. The drawdown is where the market stops being an opportunity and starts being a mirror. It reflects your true relationship with pain. You have a plan, you have an edge, and then the strategy hits the inevitable losing streak. This is the psychological pivot point. For the intermediate trader, the mind immediately defaults to sabotage. My system is broken. My edge is gone. You don't question the market. You question the foundation of your discipline. You abandon the process, not because the data changed, but because the pain became intolerable. This is the ultimate test. Discipline is not what you do when you are winning. It is what you refuse to stop doing when you are losing. It requires enduring temporary, statistical pain for the long-term compounding gain. Most people fail this test because they confuse the statistical variance of the market with a personal attack on their intelligence. We need to draw a clear line between systematic doubt and emotional panic. Systematic doubt is healthy. It means you review your last 20 trades, confirming execution quality and checking if market structure has fundamentally shifted. It is analytical, detached, and data-driven. It asks, is the system still aligned with reality? Emotional panic, however, is a sudden, frantic need to do something. It's changing trade size midweek, moving stop losses out of fear, or jumping into random trades to recover losses quickly. That frantic need to recover capital immediately is the emotional tell that you have lost your discipline. You are reacting to the P&L, not executing the process. The market does not care how much you lost yesterday. Why should you let that pain dictate today's actions? Sometimes, the highest form of discipline is the refusal to act, the ability to sit on your hands and trust the statistical edge, even when the losses hurt. This is the patience engine. It runs on the fuel of statistical probability, not emotional hope. When you are in a deep drawdown, every impulse tells you to intervene, to fight, to force a winner. The professional knows that the best trade available might be no trade at all. We must talk about emotional capital. This is the resource most traders overlook. Every undisciplined action, every revenge trade, every time you violate your rules, it doesn't just cost you financial capital. It drains your mental energy. It lowers your capacity for the next good trade. Undisciplined trades are costly because they steal your ability to execute discipline when it truly matters. You wake up the next day, mentally fatigued, forced to use willpower to stick to the plan instead of relying on habit. To protect this finite emotional capital, you must implement mandatory, non-negotiable rules for drawdowns. I call this the cool-off rule. This rule is predetermined, written down, and triggered mechanically. If your equity curve falls X%, you immediately, and I mean immediately, reduce your position size by 50%. If it falls Y%, you stop trading entirely for 48 hours. This is not a suggestion. It is a mandatory circuit breaker. You are removing your emotional self from the decision loop. You are saying, my process is sound, but my current emotional state is compromised. The goal during a drawdown is not to recover the losses. The goal is to survive the mental fatigue and protect the system. Reducing size allows you to continue executing the strategy with less emotional consequence, rebuilding confidence trade by trade without the crippling pressure of needing a massive winner. Now listen closely to the ultimate truth of market discipline. It is a profound, almost spiritual paradox. You cannot control the market. You cannot control the outcome. If you cling to the need for control, if you demand that your strategy works, right now, to validate your intelligence, you will always be a victim of volatility. That need for control is the ego's weakness. The ego wants certainty. The market offers none. The final stage of discipline, the highest level of mastery, is surrender. Surrender to the statistical reality. Surrender the need to be right. Surrender the outcome. You only control the input, your execution, your risk, your patience. When you fully internalize this, the emotional charge of a drawdown diminishes. You stop fighting the market and start executing your edge. We have identified the fortress of patience. But how do you ensure that fortress is built on solid, unwavering self-belief, even when the losses mount? How do you eliminate the self-sabotage before it even begins? That requires understanding the core identity you bring to the charts, the hidden beliefs that dictate every trade. The hidden belief is that you deserve to win, or that your analysis grants you control over the next tick. This is the ego trap, the last great frontier of self-sabotage. The only way out, the final stage of self-discipline, is surrender. I don't mean surrender to failure, I mean surrender to reality. The Stoic philosophers understood this centuries ago. They gave us the most powerful tool for mental resilience that applies directly to the charts, the dichotomy of control. You must separate what is yours and what is the market's. You cannot control the result. The profit and loss number on your screen is an external variable, subject to the randomness of millions of other participants, subject to macro events you cannot predict, and subject to volatility you cannot tame. Yet nearly every emotional failure, every revenge trade, every oversized position, every premature exit stems from the futile attempt to force that P and L number into submission. True self-discipline means surrendering the outcome entirely. You trade the setup, not the potential profit. You manage the risk, not the perceived reward. When you stop trying to control the uncontrollable, you gain absolute mastery over the only thing that matters, your execution. This is the ultimate freedom in trading. It is the great paradox of the disciplined life. Restriction breeds freedom. When your trading plan is highly restrictive, when it details exactly the conditions for entry, the precise management protocol, and the mechanical criteria for exit, it removes the burden of choice. Choice is where fear and greed live. Every time you hesitate, every time you think, should I take this trade? Should I hold a little longer? You are opening the door to self-sabotage. You are inviting the irrational self to the table. Discipline is the removal of decision-making under duress. It is the psychological liberation from feeling like you have to be right, because your only job, your only metric of success, is to follow the map you drew when you were in a state of calm, rational clarity. That map is your edge. Your fidelity to that map is your discipline. Think about what a rule violation truly is. It is not just a mistake. It is a profound act of self-disrespect. It is disrespect toward your own capital, disrespect toward the hours you spent building your edge, and most importantly, disrespect toward the future version of yourself who is depending on your consistency right now. Every broken rule is a promise broken to the most important person in your trading career, you. If you cannot respect your own rules, how can you expect the market to respect your capital? This is the core psychological shift required for professional trading. Discipline stops being a chore and starts becoming an essential component of self-respect. When you prioritize the integrity of your process over the intoxication of a quick win, you shift your identity. You stop identifying as a gambler and start identifying as an operator. Discipline is not a short-term strategy to snatch profit. It is a long-term strategy for survival. The market does not care if you hit your target tomorrow. It doesn't even notice. Your only true metric for success in this game is ensuring you are still liquid, still sane, and still executing your process 5 years from now. That requires radical consistency. It requires you to prioritize longevity over immediate gratification. The undisciplined trader is always looking for the shortcut, the adrenaline rush, the immediate reward. The professional trader understands that the reward is derived from the repetition of the mundane. The boring adherence to truth is what compounds. We talk about discipline as if it were a sudden transformation, a lightning bolt of willpower. It is not. It is built in the quiet moments, in the mundane moments when no one is watching. It is the relentless, boring, 1% adherence to truth. Discipline is the physical bridge connecting who you are today, the emotional, inconsistent operator, with the profitable, mechanical entity you know you can become. It is the silent, internal commitment that precedes external success. You are not waiting for the market to give you permission to be profitable. You are consistently giving yourself permission to execute flawlessly. This self-discipline is the only genuine edge you possess that cannot be taken away by volatility or algorithm. It is the firewall against emotional destruction. So, put down the technical analysis books for a moment. Go back to your journal. Do not look at your trades. Do not look at your P&L. Look at your rule violations. That is where your self-discipline journey truly begins. That is the starting point for building the identity of the unbreakable operator. But to truly solidify that identity, we must first confront the phantom of fear itself, the core anxiety that underlies every deviation from the plan.